Welcome back to Higgins Capital. I'm Ray Higgins, a co-founder of our company. In this video, we're going to explore 5 seasonal patterns that we see in the stock market. And those patterns are 1, the January effect, 2, sell in May and go away, 3, the September effect, 4, the October effect, and 5, the Santa Claus Rally. Thanks for subscribing to our channel. I appreciate your support. Now, let's get on with the video. The January effect occurs in the first couple of days or weeks of January and is related to year-end tax planning, other tax-related factors, and portfolio rebalancing. Investors may sell losing positions in December in order to offset gains and then reinvest in January. Because of this, January tends to be one of the better months. Number 2, sell in May and go away. This adage reflects a historical tendency for markets to underperform during the summer months. It's time for vacation. The idea here is you sell in May and you re-enter the markets in the fall. This pattern is linked to lower trading volumes and lower market activity during the summer months. Number 3 on our list of 5 seasonal patterns in the stock market is the September effect. September tends to be the worst month for stocks in the year, and this is due to several factors. One is seasonal weakness as people get back to work, children go back to school. There's a shift in market perception, and there tends to be more volatility. September is also the end of the third quarter, so you have a lot of quarter-end pre-announcements where companies try to indicate how things look on their quarterly reports. This does create quite a bit of volatility, and it leads into our third factor, which is the fact that this activity tends to lead to quarter-end rebalancing in a lot of portfolios. Our fourth pattern is the October effect. October is the month we typically reach market lows for the year. This is the result of 2 factors. First, the negative momentum from the sell-off that we usually see in September often carries through into October. Furthermore, October is a month that is historically noted for market crashes. The market crash of 1929, the market crash of 1987, where the market was down 25% in one day. The market crash of the dot-com bust, where the NASDAQ was down 78% before all was said and done. And the market crash of the great financial crisis, where Lehman Brothers went bankrupt in September. October is also the end of the fiscal year for a number of corporations, and so we typically see portfolio rebalancing based around that end of the fiscal year. The portfolio rebalancing that occurs at the end of the fiscal year usually drives market volatility. Our fifth and last pattern is the Santa Claus Rally that usually occurs in the last week or 2 of December and bleeds over into January. So you actually have an overlap between the Santa Claus Rally and the January effect. You'll typically see 3 factors in the Santa Claus Rally. First is window dressing, where portfolio managers will buy popular stocks. It makes their portfolios look good. The second factor in the Santa Claus Rally is tax loss selling and buying that we typically see at the end of the year and also into January. And last but not least is holiday optimism. People are in a great mood. The markets respond to investor sentiment. These patterns are worth investors being aware of because it helps them understand how the market is partially driven by the calendar. And as we go into what I see as the most volatile quarters of the year, I think that this helps investors to maintain their sense of perspective and not be reactive to market volatility. So these 5 patterns establish good times, bad times, and boring times. The January effect tends to be a rally. Sell in May and go away tends to be slow times. The September effect tends to be bad. The October effect tends to be bad. And the Santa Claus Rally tends to be good times. If you've watched this video to the end, I hope you have gained a better understanding of how the markets work with respect to the calendar.